So if you remember, Bear Stearns closed on Friday at $2. And on Monday, it was sold to JP Morgan. And it always ends up at JP Morgan, right? Washington Mutual, same thing.
Yeah.
Well, who can position themselves? And here's a crazy stat. Over the last 5 years, 100% of the gains of the US stock market have occurred when the market is closed, between 4 o'clock and 9:30 the next day. None of the gains happen during the day. So all these, investors trying to make money, it's just chop. All the money is made by the insiders who know what's going to happen.
Hey guys, welcome to Everyday Finance. Artificial intelligence is no longer just transforming tech, it's reshaping the entire market. As massive capital flows into AI leaders like Nvidia and Micron, Mark Yusko believes those same forces are setting up Bitcoin's next major breakout. Although Bitcoin's lack of movement has frustrated investors, Yusko argues this exhaustion is bullish. He says Bitcoin's next peak won't arrive until it starts outperforming the Magnificent Seven in market. Volatility returns to signals that historically precede major rallies, and neither is present yet. Meanwhile, the convergence of AI and blockchain is emerging as a powerful new catalyst. With AI valuations skyrocketing, capital may soon shift toward digital assets that fit an automated, data-driven economy, positioning Bitcoin as the premier digital collateral. Yusko's latest analysis also highlights broader macro factors. From US-China tensions to upcoming Fed rate cuts, all of which could accelerate the shift in global capital. If you enjoy deep, data-driven insights, be sure to like, subscribe, and explore more content.
On the flip side, there are people who say, no, you're wrong. The cycle is over. Well, why do you say that? Oh, ETF demand, nation state demand, retail demand, Morgan Stanley is saying yes, Vanguard saying yes. Okay, there's some logic to that the institutionalization of the asset will mitigate the volatility of the cycle. Okay, I'll buy that. But here's the problem. We've had this wave of interest that's been promised, and we actually have seen a lot of money come in through the ETFs, for sure.
Yeah.
But as I said, the problem with a lot of that money, it's not net long. It's actually short the other side. It's just an arbitrage, because there is, in the futures market, the future price a month out is higher than the current price. That's just the nature of futures markets. And so there's something called roll yield, where you go long the future and short the asset, and you roll down over the course of the month, and you make, in a good time, 11-ish% annualized, in a bad time, 4 or 5% annualized. But the thing about it is, it's pretty much risk-free because you're dollar neutral. So you can lever that up a decent amount. And if you're making 11% for a month, 11% annualized, but you can lever that up 5, 6, 7, 8, 10 times if you're a big institution. And it goes back to the Thomas Jefferson quote that if being a government official ever became a career, corruption would soon follow. And whether it's, the Clinton Foundation, like, who donates to the Clinton Foundation? Oh, nation states like Saudi Arabia. Well, why would they do that? Well, because they want favors from the Secretary of State. So yeah, Bill's no longer president, but Hillary had a pretty high up position. And so there's all kinds of grift and graft and corruption that's going on. And people say, you shouldn't say that about, the seated president. So it's funny. I was talking about this a couple years ago during the FTX scandal. Cause I have some receipts on how tightly linked SBF and his parents are to the Democratic Party. And, his mom runs a big Tumblr for big donors. So I'm not saying anything but I was doing this and I'm actually sitting in the same chair, and suddenly the power in our building went out. And the guys on the air were like, oh my God, did the black hats come get him? And no, they didn't. So I'm still around. But look, I'm not. I don't think it's anything like super intelligent to say that the current administration is profiting handsomely through some family entities on their flip-flopping on trade policy. I mean, look, the Kobayashi letter, great follow on Twitter if you're not following them, but they wrote out there are 8 specific steps that have happened now 5 times, not once or twice, 5 times, like 8 specific steps.
Yeah.
Okay. Trump says this, then this happens. Then Trump says this, then this happens. Then Trump says this, then this happens. All the way down to the timing. Like it's always on a Friday. Then it's always the initial walk back on Saturday morning. Then it's the full walk back on Sunday night. Well, why is it always Fridays and Sundays? Every big announcement is always on Sunday. Remember the global financial crisis? Bear Stearns, Washington Mutual. They weren't taken over on Monday or Tuesday. The announcement was made on Sunday when the markets are closed. Well, why? Well, there's something called the Council on Economic Stability, and it's made up by the Secretary of the Treasury, the head of the Fed, and the head of the 4 biggest banks, Goldman Sachs, Morgan Stanley, Citi, and JP Morgan. And they meet every Sunday at whatever time in the evening. And not shockingly, then every announcement happened on Sunday night when the markets are closed. So the only people that benefit are the people who were already positioned. So if you remember, Bear Stearns closed on Friday at $2. And on Monday, it was sold to JP Morgan. And it always ends up at JP Morgan, right? Washington Mutual, same thing.
Yeah.
Well, who can position themselves? And here's a crazy stat. Over the last 5 years, 100% of the gains of the US stock market have occurred when the market is closed, between 4 o'clock and 9:30 the next day. Mm-hmm. None of the gains happen during the day. So all these investors trying to make money, it's just chop. All the money is made by the insiders who know what's going to happen.
Mark Yusko believes the biggest catalyst for the rest of 2025 won't come from AI or Bitcoin, but from geopolitics, specifically the US-China relationship. He argues that a potential trade deal between the two countries could completely shift the macro environment, lead to Fed rate cuts, and redirect global capital flows. Despite ongoing tensions over rare earths and military supply concerns, both nations have strong incentives to ease economic pressure. If a deal happens, Yusko expects a major market rotation. Gold's recent gains could fade, while Bitcoin becomes a top beneficiary. He compares today's setup to past cycles, suggesting we may be entering a 2017-like environment where stocks and Bitcoin rallied together. With Chinese exports to the U.S. down 27% year over year, the push for normalization is growing. Yusko notes that the smartest strategy ahead of such a shift isn't going all-in, but using asymmetric bets like call options. He concludes by highlighting how psychology, liquidity, and institutional positioning are already aligning to fuel Bitcoin's next major move.
Just like SBF and FTX was not a crypto problem, was not a Bitcoin problem, was not a digital asset problem. It was bad people doing bad stuff problem.
Sure.
Right? They stole money, okay, gave it to political parties, and then lied about it and made it up. So that's just bad people doing bad stuff. And that's been going on forever. And so the same thing is true here in the sense that fair value is one thing, but what happened on Friday was not about fair value. That was about a systematic destruction of an order book, right? Mm-hmm. Because of low float and because of the way algorithmic trading works and the way leverage trading works. And look, I shouldn't rat out my family member, but I have a family member. Let's just say I won't say which one, but I have a family member, and they called me up during the 2020 crash. You know where things crashed. He says they stole my Bitcoin. I'm like, what? He says Bitfinex. I'm like, stop talking. You're the idiot that levered an 80 vol asset and you didn't make the margin call. And yes, they seized your collateral. That is not stealing your Bitcoin. Now, to be fair to him, if the business model of the business is to entice people to take ill-advised leverage positions and then seize their Bitcoin by manipulating the order book, maybe it is theft. And I probably shouldn't say that about a firm, but maybe it is. And so what happened on Friday was the largest transfer of wealth we may have seen since the industry started. Bad people doing bad stuff, but that's not a crypto problem. That's a market structure. Percent. And that, look, to that point, we had a group, big pension out of Europe, that before the Terra Luna thing had committed to us 40 to 80. They hadn't given us a final number, but 40 to 80 million dollars for our fund. When the Luna collapse happens, they're like, we're going to split it with you and another firm. So I'm now 20 to 40. Then when FTX happened, they're like, 0, we're out. Mm-hmm. Now, I went back to them last year and I said, all right, look, you missed maybe the worst vintage for venture capital in recent memory. Keith Raboy, famous venture capitalist, now he's with Open Door and other stuff. But he tweeted in November of 21, yes, we've all lost our minds. We're all overpaying for deals. And someone needs to come to their senses, but you go first. You skip this hot deal because you think the valuation's bad. And oh, by the way, I'm going to take your capacity. So we had all lost our minds so I said to them, look, you missed that. So that's going to be a bad vintage. You missed it, but you still have 0. You need to get off 0. And they're like, the board won't even let us talk about it now.
Yeah.
And I think that's going to happen in spades here because what they're going to read was this was a crypto problem. This was a Bitcoin problem. This was an ETH problem. No, it wasn't. This was bad people doing bad stuff. Dangerous. And look, I don't have all the facts on this because I haven't really dug in the way you guys have. And that's the nature of investigative journalism. It's why it's such a great thing, and we need more of it. Look, I do struggle with there's just too much centralized power in a small number of institutions in most markets. It's not just crypto markets. Mm-hmm. And in this case, the rumor, and again, I don't want to spread the rumor, but it is out there, right? Is CZ, is trying to put Wintermute out of business. Okay, that's one. You could make a logical, cogent argument for that. I'm not saying that is what happened, and I'm not saying that that's real. And look, there are lots of interconnections between, Binance and other institutions, and so I think part of the challenge, it's like Bitmain and WhatsMiner control 92% of the hash power. Mm-hmm. That's probably problematic. I'm not accusing anybody of anything. I'm not saying there's any backdoors or any tracking, but 92% is probably ill-advised.
Especially for a thing that's supposed to be so decentralized in the sense.
Yeah. So that's probably ill-advised. And 80-ish, I don't know what the number is, percent of trading going on in Binance, and it's a lot of different Binance entities that have been rolled up, is probably problematic. So, but it's really not different than any early stage market, mm-hmm. right? Think about the New York Stock Exchange when it was literally at the buttonwood tree. It was a very small group of people that met physically around the buttonwood tree and traded analog assets. And then they're like, this is really not safe because those guys in the tall hats, if you've watched, Gangs of New York, could steal our stuff. So let's move inside and let's electronify and let's have QSIPs and bank statements and we'll trade those better. but it was still dominated by a small group of, I mean, give up control of your asset,
Yes.
right? If you have to pledge your asset to a lender, to an exchange,
Yeah, don't do it.
don't do
You're
it.
cooked.
And
You're
you say,
cooked.
but I want a lever. Fine. Separate the decisions. Take a loan from somebody who you don't have to pledge your Bitcoin to. Take a HELOC. Take a student loan. And I'm not saying to do this, but what I'm saying is if you connect the two and you've lost control, the person who has control, not necessarily because they're a bad person. I mean, they could be a bad person, but I mean, if they're a bad person, then bad things will happen. But even if they're not a bad person, if they have control, they're going to execute, right? Now, we have an investment in a lending company. They didn't seize anyone's collateral. They called people up and said, hey, if you post some more collateral, we're good.
Yeah.
And everybody posted more collateral, and they have a small number of clients, so they were able to do that. And it's the same thing, that BlockFi. BlockFi was a victim in the whole thing, and I wish Zach all the best with what he's doing with Galaxy. And they did the same thing in 2020, right? Not one person had their collateral seized. Not one. They could have seized it all, but they didn't seize any of it. And so it depends who you're working with. But if you're working with somebody who the moment you're one penny below, they take it.
Mark Yusko explains that despite how bearish the crypto market may look on the surface, the underlying setup is quietly turning bullish. Volatility has collapsed. Long-term Bitcoin holders are selling into strength. And major institutions are helping move supply from old whales to new buyers. Exactly the kind of reset that historically precedes major breakouts. He also notes that some Asian capital has rotated out of Bitcoin and into AI, but he believes this is temporary. As AI valuations peak, attention and capital will swing back toward Bitcoin's fixed supply and decentralized foundation. Yusko says the real signal to watch for is when volatility returns and Bitcoin begins outperforming mega-cap tech. That's when he expects the next parabolic leg to begin. This time, he argues, the rally will be fueled not by hype, but by deep structural flows linked to AI adoption and global macro changes. He concludes by emphasizing that we're entering an era of replacement intelligence, where AI could transform labor and economic systems, creating the need for a neutral, programmable financial base layer, with Bitcoin poised to fill that role.